If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. In Q2 2025, Uruguay's GDP annual growth rate dipped to about 2.10% year-on-year, down from 3.4% in the prior quarter, signaling a significant loss of momentum in the second quarter. This gradual deceleration from earlier highs reflects mounting headwinds in trade, domestic demand, and sectoral imbalances. Although still positive, the pace of expansion no longer fully countered structural drag, and the performance in Q2 fits more with stagnation than dynamic growth. On the unemployment front, the rate showed modest easing. In June 2025, it stood at 7.3%, down from roughly 8.1% a year earlier. That improvement signals some labor market resilience, but the level still indicates considerable underutilization given Uruguay's development status. Many segments, especially youth and informal sectors, face persistent barriers to stable employment, and the modest drop likely owes more to cyclical shifts than reversal of long-term structural challenges. Turning to interest rate policy, Uruguay's benchmark rate remained at 8.75% in mid-2025, unchanged from prior periods. The central bank held this rate steady after a recent cut from 9.0%, reflecting caution in balancing inflation and growth pressures. At this level, borrowing costs remain high for households and firms, especially given Uruguay's sensitivity to global rates and external demand fluctuations. High interest rates restrain credit extension, dampen investment, and weigh on consumption decisions, contributing to the stagnation narrative in Q2. Inflation dynamics during this period were moderate but persistent. The headline inflation rate fell to 4.20% in August 2025 from 4.53% in July, suggesting easing in price pressures. In Q2, inflation hovered in the low to mid 4% range, supported by stabilization in food and energy prices and subdued demand pull pressures. Core inflation, however, remained sticky in some services and non-goods categories, underlining inflation credibility risks. The deceleration of inflation helps relieve some strain on real incomes, but disinflation was gradual, not sharp, which tempered relief for households and businesses. Regarding public debt, Uruguay's debt-to-GDP ratio reached about 70.3% in 2024 and modestly increasing to roughly 70 to 71% in 2025 as fiscal deficits persisted and debt accumulation continued. This level is high by Uruguay's own historical norms and indicates significant fiscal burden to service debt, limiting room for expansive counter-cyclical policies. The government ran a budget deficit of about 3.20% of GDP in 2024 and is projected to widen to 3.50% by the end of 2025, further adding to debt accumulation pressures. These fiscal constraints amplify stagnation risks, as the state cannot afford large stimulus without undermining debt sustainability. In Q2 2025, key metrics painted a picture of fragile expansion. GDP growth slowed to 2.1%, unemployment rose to 7.3%, and inflation lingered around 4.2%. In response, the central bank held its benchmark interest rate at a high 8.75%. Growth was highly uneven. Strong expansion in primary export sectors like agriculture was offset by contractions in utilities and stagnation in domestic-facing sectors like construction and services. This divergence underscores a key weakness: faltering domestic demand. High interest rates restrained credit for both businesses and households, dampening investment and consumption. Cautious consumer sentiment persisted, even as real incomes began to stabilize. Policymakers faced a bind. The central bank held rates to fight inflation, while debt pressures prevented fiscal stimulus. This has left Uruguay in a stagnation zone. Growth is positive but faltering, awaiting a meaningful revival in credit or demand to break the cycle. Title: Uruguay Economy, 2025, Q2 Stagnation Signals Growing Pressure. Uruguay's economy is stuck in low gear. In Q2 2025, growth momentum slowed sharply, signaling stagnation amid mounting headwinds in trade and domestic demand. GDP annual growth dipped to 2.1%, down from 3.4% in the prior quarter. On the unemployment front, the rate eased modestly to 7.3%. However, this still indicates considerable underutilization and persistent structural barriers. Turning to policy, the central bank held its benchmark interest rate at a high 8.75%. These borrowing costs restrain credit, dampen investment, and weigh on consumption. Inflation eased to 4.2%, but core inflation remained sticky, tempering relief for households and businesses. Meanwhile, public debt rose to roughly 71% of GDP, with a widening budget deficit. These fiscal constraints amplify stagnation risks, as the state cannot afford large stimulus. Looking ahead, economists expect moderate growth, but Q2 is a cautionary marker. The economy shows little sign of sustained acceleration. To restate the key metrics across 2024-2025, the GDP annual growth rate was 2.10% in Q2 2025, down from 3.4% prior. Unemployment reached 7.3% in June 2025. The benchmark interest rate was 8.75%. Inflation lingered around 4.20%, with monthly movement modest, and debt to GDP was about 70.3% with projected upticks. These figures combine to paint a picture of fragile expansion under constraints. In sectoral terms, Uruguay saw uneven contributions to growth during Q2. Agriculture, fishing, and mining delivered strong expansion, over 10% growth, while manufacturing also advanced, but at a cooling pace. Conversely, utilities suffered a contraction of nearly 7.9% in the quarter, and construction declined marginally, 0.2%, weakening the breadth of growth. Trade, lodging, and food services barely grew, 0.3%, down from prior quarters, and transport and communications fell by 0.3%. These divergences underscore that growth was concentrated in primary and export sectors, while domestic demand sectors stagnated or reversed. Credit markets were sluggish. Lending growth to private enterprises remained restrained due to elevated rates, cautious risk assessments, and low margins. Firms delayed investment in capacity and deferred capital expenditure. Household borrowing similarly slowed, particularly for durable goods and housing, further dragging consumption. The banking sector's appetite for sovereign debt remained strong, absorbing much liquidity that might otherwise have supported enterprise credit. Consumer sentiment, while not deeply pessimistic, reflected caution. Households held back on non-essential purchases amid inflation, uncertainty, and wary expectations. As inflation fell modestly, real incomes stabilized slightly, but not enough to drive sudden surges in spending. On the external side, Uruguay's current account edged near balance, with export rebounds in agriculture and commodities offset by import needs in energy, intermediate goods, and machinery. The weaker growth in trade services, tourism, lodging, added to external vulnerability. Exchange rate fluctuations played a modest supporting role. Depreciation pressures existed but were managed to prevent destabilizing inflation spillovers. In policy terms, Uruguay in Q2 faced limited levers. The central bank kept the 8.75% rate steady, unwilling to cut further without firmer disinflation evidence. Given debt pressures, fiscal authorities refrained from strong stimulus, instead aiming for modest adjustments and prioritizing expenditure efficiency over size. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.